This is the Asia Trade. I'm Shery in Tokyo.
I'm Haidi, Stroud-Watts in Sydney. The top stories this hour. Asian stocks are set for a weak open after a mixed US jobs report adds to fears the Fed is behind the curve on cuts as we count down to next week's rate decision. Also ahead, China set to further open its factory and healthcare sectors to foreign money as it seeks growth sparks. Inflation data out later, set to show further economic slack. And with Japan's AI sector beginning to draw global attention, we speak with the CEO of a startup now backed by NVIDIA.
And Haidi, with the U.S. payrolls numbers out of the way, we can really focus on CPI this week. Really, the two mandates and elements that the Fed is looking at closely, inflation and a weakening trend in the labor market, which has been a bigger focus these days. And not surprising, given that we got the payrolls numbers coming in below expectations, and we're talking about the weakest 3 months of jobs growth since 2020 or so. So really not surprising to hear from Fed speakers like Governor Christopher Waller that it's important to start cutting rates this month.
I believe that the balance of risk has shifted toward the employment side of our dual mandate and that monetary policy needs to adjust accordingly. The current batch of data no longer requires patience. It requires action.
So much at stake, particularly when it comes to this bond rally, right? In a lot of ways, those jobs numbers kind of not really clarifying the direction, or certainly if the direction, but not the magnitude of what we might see from the Fed. Interestingly, we also heard from Janet Yellen talking about the idea that there's no red lights flashing as the US is still seems to be making that soft landing. So the Treasury Secretary saying that she's attentive to that downside job risk, but reiterating also some of the external risks there. The importance of engaging with China was something that she mentioned as well. But the kinds of metrics that we would monitor to summarise risks, she says, things look good. Take a listen.
Overall, I would say for the U.S., the kinds of metrics that we would monitor that would summarize risks, whether it's asset valuations or the degree of leverage, things look good. There are not, I don't see red lights flashing.
Talking about asset valuations, take a look at how futures are coming online in the Asian session. We'll continue to see a little bit of downside pressure. Of course, we had the S&P 500 seeing the worst week since March of 2023. Remember, that's the time when we had the regional banking turmoil with the collapse of Silicon Valley. But really, you have to put it into context, right? Because we're talking about the NASDAQ 100 also seeing the worst week since 2020. And yet, we're still seeing a huge run-up this year. The S&P 500 is still up more than 10%. So we continue to watch yields as well, because especially the two-year yield, of course, we're headed to the Fed rate decision next week, is now below that 370 level. And remember, in April, we were at around 5%. Crude prices at the moment at around the $71 a barrel, but that has really been impacted by sort of the outlook and the recession fears that we saw last week. Not only about the U.S. economy, but take a look at the Asian markets, because we were a little bit nervous about those China economic numbers also out. We'll continue to watch trade numbers, not to mention the activity data that we're getting from China, the offshore yuan holding steady at around that 7 level. We continue to see a little bit of downside pressure on the Australian futures, Nikkei futures also to the downside, and this, of course, after we lost ground on the Nikkei as well. Not surprising with the Japanese yen really strengthening against the U.S. dollar, up at the highest level in about a month or so against the greenback. And we're watching very closely comments by the former BOJ Governor Haruhiko Kuroda as well, talking about there being still a long way to go to reach that neutral rate for the BOJ, Haidi.
Yeah, and lots of implications for the BOJ and other Asian central banks in terms of how quickly the Fed moves from here, right? Let's get some perspective from Louis Kaus, who's the APAC chief economist at S&P Global Ratings. Louis, always great to have you with us. What did you make of this, what was ultimately perceived as quite a mixed set of numbers, right, and the kind of non-committal commentary from the Fed? Does it give any further clarification as to where they'll go from here, how quickly, and whether it's perhaps a little bit too late and on the back foot now?
Yeah, good to be here. So I think As always, the Fed wants to portray itself as being very data dependent. They want to anchor their policies in the data. But I think the data so far has been broadly in line with what we are all expecting, a September rate cut. So I think that is in the bag. The question, of course, is, how many and what size the cuts will be later on. But I think that September rate cut should be pretty much taken for granted.
You talk about data dependent, but there's also a lot of risks that are yet to materialise potentially, right? How much are you watching, for example, we heard Janet Yellen talking about the importance of engaging with China as its structural slowdown continues to play out, but there's also the US election, a lot of those geopolitical concerns, as well as fiscal uncertainties as well.
Yeah, of course. So there are lots of risks, of course, around the global economy, US economy, both in terms of how much is growth going to slow? Will that soft landing that we're all expecting, will it actually materialize, right? And then, of course, as you indicate, and as Janet Yellen also said, the global economy nowadays matters quite a bit for the Fed, as it does for the US overall. So all in all, a lot of, angles to look at. But I would say at the moment, the Fed, as they say themselves, right, are paying a lot of attention to the labor market. And we see that labor market cooling. It's not crashing, but it is cooling.
When it comes to the global economy, Japan seems to be on a solid recovery trend. We're going to get the GDP numbers out today. What are you expecting?
So in Japan, we had a pretty good Q2 in terms of the data, second quarter. And I think more generally, what we have seen is that earlier in the year, consumption was a bit weak, and consumption is by far the largest component of the economy, right? Consumption was weak. The good news for Japan is that wage growth is starting to pick up. Like Japanese consumers have been facing very weak real household income development. That's getting better because that wage growth is starting to pick up. We see the impact of spring negotiations, which were really good. We see that impact starting to filter through in the overall data. And so we're now looking at positive household income growth year on year. And that is, that should start to show its impact in consumption.
Does that mean that the BOJ should keep raising rates from here? I mean, we got some indications from the former BOJ governor, Haruhiko Kuroda, where he thinks a neutral rate stands at around that 1.5%.
Yeah, so it is our view that the BOJ will gradually, in the coming years, move its rate towards somewhere between 1 and 1.5%, but we don't think that they're going to move fast. And we've seen, a few hiccups. I wouldn't say, well, quite a bit of turbulence, right, after the last increase of the Bank of Japan. And also, we know that the Bank of Japan is looking a lot, again, at that global economy, which from their perspective is starting to slow and where they see some risk. So I think it's going to take a while before they'll, implement a further increase.
Well, yeah, I wanted to get to one sort of particular aspect of the China recovery. You've got pretty soft consumption and demand domestically. At the same time, you have very robust manufacturing investment, particularly when it comes to, geopolitically sensitive areas. Does this tension continue? Because it seems like things like EVs and solar are really one of the pillars of the economic recovery strategy for President Xi.
Yeah, definitely. We see in China, have been seeing this pattern of weak consumption, weak domestic demand, pretty good manufacturing investment and really good exports. We've been highlighting for quite a while now that that's not a very positive picture for the Chinese economy. It's putting pressure on prices, on profit margins. It's also, of course, making things challenging in the global market, China's economic relations with other economies. So I think we're all waiting for more stimulus to help demand. We're looking for a pickup in that demand in China. To be honest, I think it's only going to happen when we see the real estate market bottoming out. So it may actually take a while.
Could we see that pickup reflected in today's CPI, PPI numbers, or not just yet?
A bit early for that. So I don't think so.
What are your expectations for the inflationary trend in China?
So, as I said, we have this downward pressure on prices. We think it's going to be only quite late in this year that we will finally have more than 1% CPI inflation. So, it's going to be still showing that impact from that weak demand in the Chinese economy.
Louis Cowles, good to have you back. APAC chief economist at S&P Global Ratings, setting the week, of course, on the busy eco week for Asia as well. Coming up on the Asia trade, the CEO of Sakana AI joins us after NVIDIA invested in the Japanese startup's latest funding round. We'll also dig into markets with DBS Bank, and we're at the CITIC CLSA Investors Forum talking U.S. elections with pollster Frank Luntz. This is Bloomberg.
On September 10th, as Election Day approaches, Vice President Harris and former President Trump hit the stage for the first time.
Oh, we're going to beat her. I look forward to the debate.
If you got something to say it to my face.
We'll bring you informative analysis.
Will that debate decide the outcome of this election?
It's going to come down to both policy and performance.
Tune in to Bloomberg Television for the ABC News presidential debate simulcast with special coverage starting at 8 p.m. Eastern. Context changes everything.
Shery, we're looking ahead to the price data for China to be released a little bit later, and the expectations are pretty low, right? We're expected to see further evidence of that sort of erosion of the economic growth spark, with CPI expected to flatline, producer side inflation expected to deflation, as I said, to really expected to be deepening. And a lot of this is feeding through to kind of the fading recovery hopes for the Chinese equity side as well. That weakness that we see in Chinese markets is eroding the confidence of even some of Wall Street's staunchest supporters of the Chinese shares that have been hoping for that turnaround. We've seen over the past 2 weeks long-standing China bulls from UBS Global Wealth, Nomura to JP Morgan Chase, all downgrading the country's equities. And a lot of this, Shery, is being reflected in the fear that that 5% inflation target, the growth target, I should say, will not be met. So a lot really hinges in terms of what we see from the economic data, but the expectations are not that high.
Yeah, especially for equity markets. Take a look at the CSI 300, the benchmark index, down more than 5% year to date. And of course, this we're talking about at a time when we're seeing a global equity rally, right? And this would make it a record fourth year of losses for the CSI 300. And don't even get started on the incredible bond rally that we've seen in China, of course, with fears of recession, a lot of safe haven demand right there. 10-year yields, fresh record lows. The 30-year bond yield also extending declines past its near two-decade low as well. And of course, you know it very well in the Australian market that gets hit anytime that iron ore takes a hit. And we're seeing those futures also trading near 2022 levels.
Yeah, one investor likening this to, throwing in the towel when it comes to China. So we'll wait to see what this week's trading has in store. But Shery, we're also hearing that China will fully open its manufacturing sector to foreign investment. It's also allowing more room for overseas capital in its health sector. China correspondent Min Min Lo joins us now in Hong Kong with the latest. And these overtures clearly another move to try and reinvigorate growth in the domestic economy. What do we know?
Yes, so the government has just released the 2024 version of the negative list for foreign investment into the country, and they have now lifted all restrictions for the manufacturing sector. Bear in mind that there has already been zero restrictions in the free trade zone, so the ones that they're lifting applies to those outside free trade zones, pretty minor ones that had remained, such as requiring majority Chinese ownership of printing factories, for instance. So these will all be lifted by November 1st. But I think what's more significant is that the Commerce Ministry has separately announced that they will also be liberalizing the healthcare sector to allow full foreign ownership of hospitals in all the Tier 1 cities, Beijing, Shanghai, Guangzhou, Shenzhen, as well as several other big cities as well, although foreign investors are not allowed to acquire public hospitals or businesses related to traditional Chinese medicine. Biotech is also a sector that will benefit from foreign investments. They can now engage in the development and technological applications of gene therapy, stem cell treatment, and so on. So these are pretty significant moves. And also in a press conference later, officials also pledged to look into policies revisions to open up the services sector as well to foreign investors.
I mean, we continue to hear about this barrage of new measures coming from Beijing in order to support the economy. So how significant are these compared to everything else that the government has already done?
Yeah, Beijing does revise the negative list from time to time, so this would help. It's really clearly a bid to attract more inflows into the country because we have seen, massive outflows of investment out of China. It was down nearly 30% year to date, at least in the first 7 months of this year. And you've also heard frequent complaints from these, foreign chambers of commerce talking about these unfair playing field that is tilted against foreign investments. And remember, the EU not too long ago had opened a probe into whether China is unfairly limiting access to EU medical devices into the industry. So all of these measures to open up comes less than 2 months after the third plenum when Communist Party officials had pledged to open up various sectors of the economy to foreign investment. This will hopefully go some way to assuage foreign investors' fears around not just the weak economy, but some of the geopolitical concerns with the U.S. tariffs and all sorts of measures, and the fears around violating China's own national security and data security rules as well that has seen some companies getting raided in the past. So hopefully some of these measures could, it's being touted at least by Chinese state media as a juxtaposition to the U.S. protectionist measures that China is embracing this opening up of its economy to the world.
We just had a look at the expectations when it comes to inflation to be released today. This is not exactly going to add to confidence about the recovery.
Yeah, so the expectation, as you said, is not very positive. Inflation expected to improve slightly to 0.7%, but producers' price index, that is the most worrying one, is expected to decline to negative 1.5% versus the previous month, a decline of 0.8%. So this, again, is fueling fears around these vicious cycle of companies deleveraging and pulling back investment and hiring, and then perpetuating these fears around income growth and causing consumers to hold back spending. So this was precisely what the former PBOC governor Yi Gang had been talking about last week at a financial conference in Shanghai. He said inflation is that target that China really needs to focus on right now. He's hoping that the producers' price index will turn positive by the end of this year, but it just doesn't look like we're on track for that. Given the expectations now, we're seeing an expectation of a 23rd straight month of declines in the producers' price index.
Bloomberg's China correspondent Ming Lo there with the latest on the Chinese economy. And of course, things don't get easier for Beijing if we have more geopolitical tensions, especially around the U.S. presidential elections. Republican presidential nominee Donald Trump leading Democratic contender Kamala Harris by 1 percentage point. In a poll taken late last week, the New York Times Siena College survey has Trump at 48% to 47% for the vice president. Meanwhile, Trump says countries that trade with currencies other than the dollar will not do business with the U.S. if he wins office again. And they would face 100% tariffs on their goods. Venezuelan opposition leader Edmundo González has been granted political asylum in Spain after fleeing his homeland to avoid arrest. It comes a month after the opposition presented voting records they say prove González won the July 28th presidential election. But Venezuelan authorities said Nicolás Maduro was re-elected to a third term and ordered the opposition candidate's arrest. A gunman has killed 3 Israelis at a terminal on Jordan's border with the West Bank, the first such incident since the war in Gaza began. Israel's army says the gunman accessed a bridge crossing from the Jordanian side in a truck and fired shots before he was killed. The victims were identified as forklift operators over the age of 50. Israel closed the crossing while checking the truck for explosives. We have more ahead on the Asia trade. This is Bloomberg. We'll be watching 7 and I when trading gets underway here in Japan in about half an hour. Alimentación Couche-Tard says it remains focused on sealing the deal with the company after the Japanese convenience store operator rejected its initial proposal. Bloomberg senior editor Reed Stevenson joins us now. Reed, how ugly could this get?
Well, so far, I mean, there are no signs that it's going to get ugly. What we have had really over the course of the weekend is 7 and I's initial response to Couche-Tard's approach. Until then, we didn't know the price, we didn't know the terms, we didn't know really anything about this deal. Now we're in a new phase where we now have a price. It's about, in US dollars, close to $15. In fact, that's right where 7 and I shares are trading at the moment. So on Friday, we had 7 and I coming out and saying, look, this offer is not good enough, but we're open to more talks. And then now on Monday morning here in Asia, we have Couche-Tard's response saying, we're willing to talk. We're confident that we can get this deal done. So now sort of, you know, the situation we're in is the dance begins, right? They're going to start talking. We don't know how public it's going to be, but at least at the very beginning, we're going to see some action in the shares when the market opens here in about 35 minutes. And given the sort of tone here, probably the shares are going to go up, but you never know.
Yeah, I suppose in one way it gives investors some clarity, right? So this is really about extracting shareholder value as opposed to, you know, the other narrative, which was trying to get, you know, look at this business as one that's protected by the state and has, you know, national strategic interests attached. Do we kind of pay less attention to that second part now?
Well, those are the key things to watch. I mean, really sort of the protectionist tendencies of Japan that we've seen up until now. Now, a lot has changed. The environment has changed. There are new guidelines on takeovers. There's improved corporate governance. And so the environment has been created for a deal like this to be done, which in fact would be the biggest ever in corporate Japanese history. And then on the flip side, there's sort of the regulatory environment on both sides of the pond. You have a lot of overlap between these two companies, given their global footprint, especially that of 7 and I's. And so some sort of divestitures is almost certainly going to be necessary. But again, what Couche-Tard is saying is that those hurdles can be overcome, whereas 7 and I, to a certain extent, called out Couche-Tard, saying that it wasn't specific enough in what it was looking at in terms of some of the changes, at least the regulatory changes that are going to have to be made.
Really, if this actually happens, this could be the biggest ever foreign takeover of a Japanese company, right? At this point in time, do we have any idea from past acquisitions of what the timeline could look like, what the procedures could look like?
Yeah, I mean, there really is no prior example, so it's hard to give a timeline. I mean, if you look at Toshiba, which ultimately ended up in sort of a consortium made up of Japanese investors, I mean, that played out over months and years. This process, we're about 3 weeks into it so far, and it seems to be going pretty normal. But really, just hard to say how long it's going to take for this to play out.
Senior editor Reed Stevenson with the latest on 7 and I. More ahead on the Asia trade. This is Bloomberg.
This report is better than in July.
We think the economy is definitely slowing.
It's a little bit weaker on margin.
This economy is not slowing down in the way that markets are anticipating.
When we think about September, we think 25 basis points is quite reasonable.
It's hard to say, which way they go. I think, the market is pushing for 50.
25 is the right number, given that literally everything in this report was better than in July.
I don't think this report is definitive on the 25 versus 50.
Is monetary policy really so restrictive? It doesn't look like it's restrictive. If it was really restrictive, the employment report would be a lot weaker.
The Fed, they need to adjust policy back to more normal levels, and the question is just how quick do they want to do that?
Some of our guests, they're reacting to August's US jobs report, which in a lot of ways was really kind of throwing up more questions than answers for these markets that are so desperate for a definitive path ahead for the Fed. And you can see that caution being reflected in how futures are being priced at the moment going into the start of this trading week here in Asia. Sydney futures off by about 1.3%. We're also seeing a pretty significant drop expected when Japan gets online in about half an hour. 3.3% is how Nikkei futures are pricing in Singapore at the moment. S&P futures looking pretty flat there as well. There is this sort of ongoing concern that despite the reassurances of that soft landing, that perhaps the Fed has waited too long to cut rates. We are seeing some steep losses expected at the start of trading, Shery.
Yeah, and of course, we're also watching those Apple suppliers because Apple's most important event of the year happens later Monday when it's expected to roll out its latest iPhones and set the stage for a new AI platform. Our tech reporter Annabelle Drulers and Bloomberg Intelligence senior equity analyst Stephen Singh join us now. And Belle, let me start with you and what we can expect from this product launch event by Apple.
Well, we're actually not expecting really any sort of major changes. So later today, we're going to get the full iPhone 16 lineup, the base model, the Plus, the Pro, and then the Pro Max. Now, there had been a lot of expectation around this that we'd set off a new upgrade super cycle. But when it boils down to it, our team really isn't expecting that because you're not really going to see likely too much change from last year to this year. It's going to be sort of the same looking device. Yeah, we're going to get some new colours. The Pro devices might have a slightly bigger screen. The action button, a lot of details in that, but just suffice to say it changed to or replaced the mute switch. But that action button that was a Pro version or gadget now could become standard. There's also going to be a new button to assist taking photos. So that's sort of the more hardware and appearance-related changes. Software-wise, that's really where a lot of the excitement is because Apple Intelligence was unveiled earlier this year, rather. These are going to be the first devices that come with artificial intelligence embedded. But again, we've been road testing these at Bloomberg. Our reporter Mark Gurman has been the one doing that. And his view is that basically we're so far very far or quite a short, really, from that vision that Apple presented early this year. So again, just to reiterate, not expecting any major changes and not expecting any major upgrade cycle to be triggered off the back.
In light of that sort of managed expectations, Stephen, do we see certain carriers or suppliers set to gain from iPhone 16?
Yes, I think obviously we're looking at the incremental upgrade, but still I think some suppliers are potentially benefit from that. For example, we're looking at the camera upgrade for the 16 Pro's model. We're talking about the inclusion of the periscope camera and also the ultra-wide camera will be upgraded to 48 megapixel. So that implies better ASP for the lens supplier. So we're talking about a company like a Largan Precision or like a Sunny Optical. So those can benefit from this upgrade. And also we see some market share shift in terms of auto allocation. So on the assembler side, we see the Luxury, which keep gaining share. And it will become, so have no problem to register double-digit growth this year. And also we see LG Display, which may gain share in this iPhone OLED display order share. So those could be the potential beneficiary from this new model.
Stephen, without meaningful upgrades, how well can we expect Apple to do the rest of the year, especially given that today or the rest of the week as well, we're expecting to get more weakening data from China as well?
Okay, I think in China last year, Apple was obviously under some pressure, partially due to the launch of Huawei's new phone, P60, which actually took the market by surprise, and actually added a lot of pressure on iPhone. But for this year, I think Apple actually got a relatively lower comparison base in China. So even though we don't really expect a major hardware upgrade, and the software feature, as this AI feature, may not be available in China anytime soon. But interestingly, one of our survey in Q2 this year indicating that the consumer in China actually feel more interested in an iPhone now this year, which means that, and also we see the iPhone's growth has been improving over the past few months in China. So now without a major flagship model launched in Q3 in China for other Android brand, I do believe iPhone has a decent chance to resume growth in the coming quarters.
Just hours after Apple, we're expecting a new product launch from Huawei as well, Belle.
Yeah, that's right. And to Stephen's point there, I mean, it has been pretty intense rivalry in the Chinese smartphone market. And we actually saw Huawei edging out Apple in the June period, given the success of that Mate 60 series. So given we've got that event just, yes, very much hot on the heels, tells us that Huawei is preparing to go head-to-head with Apple for yet another launch. The focus this time is going to be on a device that could be foldable, not foldable twice. Perhaps we're used to that, but this is going to be able to be folded possibly 3 times. So that's going to allow it to fit an even larger tablet-like screen inside the dimensions of a regular smartphone. So that's the device that we're expecting. The company's really been teasing this already, saying that it was 5 years in the making. What else we're expecting, and something else that could be very closely tracked by the market, is any sort of announcements that we get around semiconductors, because the event is actually going to be led by Huawei's chips unit. And what we're hearing is that, or what other media outlets actually are reporting, this is the SMP that I'm referring to here, but they're saying that we could get a groundbreaking AI chip that would rival the products from the likes of NVIDIA that are already banned on the mainland. So something that could be very significant, especially when you're continuing to see those US efforts to curtail China's capabilities in advanced semiconductor manufacturing.
Tech reporter Annabelle Jewellers and our Bloomberg Intelligence senior equity analyst Stephen saying there. You can read more about Apple, the rise to become the world's most valuable company. That's actually today's big take, and subscribers can get that story in full on the terminal and also on Bloomberg.com. More ahead on the Asia trade. This is Bloomberg. Take a look at the weakness that we're seeing across commodities and materials ahead of China inflation data expected to show further deflationary pressures. We are seeing iron ore falling below $90 a tonne for the first time since November 2022. Of course, that time frame seeing some sort of COVID era related distortions there, but certainly we have been nearing that level for the past sort of few weeks there, and in fact managed to see a bit of a rise from that lowest close since November 2022. Some of those bearish investors taking a pause, but seem to be right back at it today. It has been a pretty sharp slump for iron ore. We had 5 days of losses going into the end of last week. Some pretty torrid conditions for China's domestic steel market, where we're seeing really key product pricing like rebar, hot rolled coil continuing to see softness, and not much prospect of a recovery in demand there as well. For last week, we saw iron ore down by almost about 10%. So clearly not much of an improvement as we get into a day, Shery, of a lot of China news flow there as well. We're seeing a bit of a different story there for oil, something of a rebound after what was also a pretty difficult week.
And of course, Haidi will also be watching those semiconductor names, tech names, given last week we saw really the worst week for the Nasdaq 100 since 2022 or so. And those AI-related shares in Japan will be in focus. They had really a terrible week last week as well, given that some of those stocks especially those Japanese cable makers that outfit data centers, putting these AI applications to work, they were really under pressure, given, of course, the sort of negative sentiment and bearish sentiment that we have seen accumulating with NVIDIA's fall of about 14% last week or so. So we'll be watching those stocks here in Japan, especially as the country is beginning to draw global attention as an AI market. Microsoft, for example, investing nearly $3 billion in AI here in Japan and cloud infrastructure as well, while OpenAI just opened an office in Tokyo. And now NVIDIA has joined a $100 million plus funding round for startup Sakana AI, which sets out to train low-cost generative models using small data sets. Joining us now is David Ha, co-founder and CEO at Sakana AI. David, great to have you with us. When I heard the name of your company, I was thinking, does it really mean fish? I mean, is there another meaning for Sakana in Japanese? But there's a reason for that, right? Tell us a little bit about the technology that you're trying to develop.
Oh, thanks for having me on the show, Shery. So, yeah, Sakana AI is a weird name. Sakana means fish in Japan. We started this company around 1 year ago. Many of us were from Google. And back then, we saw that many of the AI developments were focused around bigger models, bigger data, larger energy requirements. And we thought there are many more ways to advance AI technology in the foundational AI space. So we set out to start a company called Sakana AI, where a lot of our R&D inspiration comes from things like collective intelligence, school of fish. And I think within this year, we've shown some substantial progress in our R&D. The other factor of us starting our company in Japan, our name being a Japanese name, is that there's the geopolitical factors, deglobalization, and we think that a strong economy like Japan would want to advance their own AI ecosystem, and we want to be part of that.
How many people do you have working here in Japan, and any other considerations for growing your startup right now?
So we have around 20 employees right now, but after this funding round, we would maybe grow a bit. We are primarily a Japanese company, so many of our job applicants are expected to come to Japan to work for us. But surprisingly, this was not that big of an issue because I think Japan is a popular country. People like to travel here, and many great researchers and engineers internationally would want the opportunity to work in Japan for a leading edge R&D company.
When you talk about the democratization of AI, what do you mean by that?
Well, the technology we're developing, we want to focus on a large number of small models that work together rather than having single foundation models. That's one of our R&D directions. I mean, as even you folks recently mentioned in today, there's many new developments with respect to embedded devices, new phones, etc. And we think there's going to be huge demand in AI foundation models that would work really well in a phone on a device, but they will work together with several other models as well. And I think these kind of technologies should help us move the needle in that regard compared to the traditional method of developing very large single foundation models that are dominated by a couple of platforms.
How much does it help having a backer like NVIDIA when it comes to moving that needle?
I think it helps a lot. I think NVIDIA's team is great. We've set up a collaboration where we would not only have R&D collaboration, where we're working with their engineers and researchers on the next frontier of AI chips. We're also working on things like developing the AI community together in Japan, and also potentially looking at the development of the AI data center space in Japan, which I think, as you know, it's going to be a growing sector as well in Asia.
Any more plans to raise more money at this point?
Oh, well, I mean, we announced our Series A. I think, we have more than $100 million. I think potentially we will have more strategic investors coming up in Japan. But I think this will give us more than enough ammunition, as a war chest, to develop our technology going forward for several years.
David, really great to have you with us. David Ha, co-founder and CEO at Sakana AI. Japanese companies are increasingly abandoning an approach to business in China that once seemed immune to politics. It's a significant shift for a country that was once the biggest single investor in the Chinese economy. Senior reporter for the Chinese economy and government, James Mager, joins us now. So, James, we have really seen, the sort of winds of political tension have an impact when it comes to some Japanese companies and businesses in China, right? What's the scenario that we're looking at now?
Yeah, as many other companies have seen over the last couple of years, China is not an attractive investment destination right now for foreign firms. The first big issue really is the economy is terrible. There isn't the returns. You can't get the returns here that you could have got 5 years ago. You're not getting the 10%. There's not the 10% GDP growth that we were seeing before the pandemic. And then you're seeing you can get 5% growth by just buying treasuries in the US, or you could until recently. And so the attractiveness of China as an investment market where returns are low, where the risks are much higher, both geopolitical risks, for example, Nippon Steel was criticized in the US because they had an investment in China, and that affected their attempt to buy US steel. So there's those kind of geopolitical risks. And there's also the risks of actually doing business in China. A quite senior Japanese pharmaceutical executive was arrested for espionage. There's a lot of concern about the anti-espionage law and how that will work. There's a lot of concern about whether companies can take their data out of China now. And so there's these specific market, Chinese market questions as well, which are also raising the risk for Japanese companies. So when they look at the risk-return ratio, they're saying we're not going to get as much money, you're not going to make as much profit as we thought we were going to, and the risks of something becomes so much higher. Why do we want to be in this market? There's also some very specific China and Japan issues. Japan, China obviously have very fraught historical ties after Japan invaded and tried to colonize China in the 1930s, and those have continued to rear their head. You saw last year there was a big outcry in China about the Japanese release of water from Fukushima, and that led to things like bomb threats against Japanese schools in China, bomb threats against the embassy, people throwing rocks at the consulate in Shanghai, things like that, which again makes Japanese citizens worried for their safety. There was a stabbing incident earlier this year where a mother and child was stabbed in Suzhou, and all those things make Japanese people look at China and say, why would I put my money there when I can make more money and there's less risk if putting it in America or in Europe or in Southeast Asia?
When it comes to China, there was always that sense of FOMO, right? The fear of missing out, which is why they would always hedge and have some sort of investments in the Chinese market. Do any of the measures taken by Beijing, and today we've been reporting about them opening to foreign investors in the manufacturing sector, even in healthcare, will any of those measures help?
Beijing has been talking now for at least, since the start of 2023 when they reopened from COVID, about all the things they're going to do to improve the foreign investor situation and make people come back. So far, really none of those have either been actually happened in a real sense, or they're not enough. You're seeing other chambers of commerce, other companies, the Europeans, for example, are saying, we've got promise fatigue. You keep telling us all these really great things, and yet you don't do them. And I think for Japanese companies, it's the same. What I'm not saying in this story is that Japanese companies are pulling out. Companies like Toyota and Nissan and Honda still want to be here. This is still the largest car market, for example, and Japan is a massive car manufacturing country. And so those kind of companies are not leaving, but they're not seeing the return, or they're not seeing the possibility of good returns that would cause them to radically increase the amount of money they have here. So, there is definitely that feeling of FOMO. And some companies are increasing some things, on the margins, doing R&D to localize their products more, for example, working to improve the user interface in their cars, more EV models for the Chinese market. But there's not going to be the massive investments we've seen over the last 40 years since China opened up.
Our senior reporter of the Chinese economy and government, James Maker, there with the latest on that Japan-China relationship. As we're getting breaking news here in Japan, we are getting the GDP numbers for the second quarter. These are the final figures, and we're seeing them come in at an annualized basis of 2.9% growth, second quarter GDP. The preliminary numbers that we were seeing were growth of more than 3%. So it's a little bit of a softening and a downward revision, but it doesn't necessarily change the overall picture. We have seen pretty strong private consumption and investment as well in other more current data. When it comes to the quarter-on-quarter number, growth of 0.7%. The expectation was around 0.8%. So a little bit of a miss when it comes to growth. When it comes to the trade numbers, we're also getting the adjusted current account surplus of 3.19 trillion yen for the month of July, which is slightly above expectations, and also the trade deficit coming in at 482.7 billion yen. We'll be watching those trade numbers because those are the July numbers, which means at that time we had the yen at around that 160 level at record lows against the US dollar. Again, GDP for the second quarter, annualized growth of 2.9% quarter-on-quarter, a little bit of a downward revision there. Catch Japan Ahead every Monday at 8:40 a.m. if you're watching in Tokyo, 7:40 p.m. Sunday in New York, and subscribers can watch live on the terminal using the TV Go function. This is Bloomberg. Take a look at how futures are setting up right now. Nikkei futures down 3%. We could see downside of about 1,000 points, especially after we saw really those U.S. payrolls numbers missing expectations. We saw the dollar weakening and the Japanese yen gaining on the back of that. We're talking about a one-month high against the greenback for the Japanese yen. We just had the second quarter GDP being revised down to growth of 2.9%, annualized quarter-on-quarter. We're watching U.S. futures not really doing much, but Haidi, this, of course, after we saw the S&P 500 experience its worst week since March 2023. Remember, that was during the banking turmoil with Silicon Valley Bank collapsing.
We're also seeing weakness going all the way back to November 2022 when it comes to the iron ore price at the moment, falling to that $90 level per tonne for the first time since close to the end of 2022. There are some seasonal sort of COVID lockdown-related distortions at play there, but certainly it's a very good indication of just the weakness in pricing and profitability that we continue to see sustained within China's domestic steel industry, as well as these concerns that we're just not seeing really much growth impetus to the upside. We are getting those CPI numbers. Producer price inflation expected to really further fall into deflation territory. Consumer prices likely to see a flat line at best from China. All of this is going to be weighing on sort of manufacturers and broader industrial profitability as well. So we are seeing iron ore again, after that brief recovery, falling again to that $90 a tonne level there. These bearish investors took a pause last week after 5 sessions of losses, but back at it today. Watching those miners when Sydney comes online.
This is the Asia Trade. We're counting down to Asia's major market opens. We could see a big downside, Haidi, after we got the S&P 500 just logging its worst week since March of 2023. Of course, we have U.S. payrolls out of the way, weaker than forecast, but U.S. CPI numbers also coming up.
Yeah, are we counting down or are we bracing for impact? It looks like we're going to see some pretty steep losses, right? The China story not helping either. Expected the inflation numbers to continue to be weak. And Shery, you're already seeing that really being reflected in that drop in iron ore prices back to $90 a tonne.
Yeah, we'll be watching those commodities-related stocks as well as those tech-related stocks because, of course, we had the Nasdaq 100 also seeing its worst week since 2022. But we had the Japanese yen on the back of that weaker than expected U.S. payrolls data and on the back of weaker U.S. dollar strength in the Japanese yen. Right now, a little bit of weakness, but still at around the 142 level. And that's really pressuring the equity markets as well. We had already seen pressure in Japanese stock markets on the Friday session as well. We're watching the 10-year yield as well because it's still below that 0.9% level. We continue to see yields globally really being pressured. We had second quarter GDP numbers, a final numbers out of Japan, as expected, a slight revision downwards. But the overall trend seems to stay intact, which is we are seeing better wage growth, especially in real terms in Japan. We're seeing also better private consumption. What that means is that potentially the BOJ could continue hiking rates, and that discrepancy will really be felt on the Japanese yen that could see more strength from here. But take a look at how the Kospi and the Kosdaq are coming online in South Korea. Of course, we had a lot of pressure when it came to those chip stocks as well. NVIDIA lost, 14% last week or so. So tech stocks haven't really been doing well. Across Asia, we're seeing the Kospi also down almost 2%. The tech-heavy Kosdaq also down almost 1.5%. A little bit more strength perhaps on the Korean won, but we have already seen incredible weakness on the Korean won against the U.S. dollar as well. So we're past the 1,300 level, Heidi.
Take a look at Shery. We're watching when it comes to the start of the action here in Sydney. We're expecting that weakness to come through as well. It is a staggered start, of course, so we'll see that sort of just trickle online, but certainly we'll be watching for some of the big iron ore miners as well. We see that weakness and that sustained concern over Chinese steelmaking mills really continue to play out. That China inflation data, of course, really in focus today as well. We are seeing a little bit more strength when it comes to perhaps resilience in the Aussie dollar that could be expected. 66.69 is where we're at the moment. That further weakness, though, coming out of China could see this China proxy seeing a bit more further downside. Of course, the dollar side of things really does complicate matters there. Watching treasuries there as well, as we saw, really they were trading at pretty fresh highs after we heard from the Fed's Waller saying that he's open-minded about the potential for a more jumbo-sized rate cut and would advocate for one if appropriate. We are also watching other sort of broader commodities markets there as well. Take a look at oil. We had seen sort of bounce off a pretty terrible week last week, and a little bit of upside for crude trading this morning.
Heidi, let's bring in our next guest, Carie Lee's global market strategist at DBS Bank Hong Kong. Carie, so really a lot to digest for investors across Asia this week. Of course, we have been talking about really the tech pressure, and not to mention US CPI numbers coming up. We have Apple's iPhone launch as well, suppliers in focus. What are the big drivers for you this week?
Well, last Friday, we take a look at the labor market data. It means that they are still not certain about the rate cut size going forward, whether there will be a 25 basis point cut, a 50 basis point cut. And I think the market is still like 30% to 70%, that kind of odds. And the key focus this week will be on the CPI data and PPI data, and also next week's retail sales data before the September FOMC. To us, we still believe that there is more likely to be a 25 basis point cut, which means that currently the market is still pricing too aggressive rate cuts by the Fed. If that is the case, then probably we are going to see a rebound in terms of the US dollar against the other major currencies.
Does that mean that the rally that we're seeing in the Japanese yen might not be necessarily sustained if we don't see those aggressive rate cuts by the Fed?
Right. For the dollar yen, actually, we think it's going to be supported around 140 level for two reasons. The first one is that for the safe haven demand, which has been supporting the yen lately, we don't think it is going to be sustainable because now the concerns about the U.S. economic outlook looks a bit overdone. If we take a look at some jobs data like initial jobless claim, the unemployment rate, and the wage growth, it does not point to a very disastrous situation in the labor market of the U.S. And then on the other hand, if we take a look at the yield differential between the U.S. and Japan, we also don't think it's going to be narrowing aggressively because for one thing, the U.S. is unlikely to cut rates as aggressively as expected. And on the other hand, for the BOJ, we also think they're going to be cautious about the next rate hike after the recent market routes.
To that end, does that mean you expect not a terrible outcome when it comes to global equities? Our question of the day from our MLive blog is really, given the weakness and the sort of jitters that we see, do you expect to see global stocks then ultimately falling into a correction to extend these recent declines?
Well, for the global stocks, actually, we think there are two risks ahead. The first one is that market may have overpriced the Fed rate cuts. If that is the case, then when the market reprices the Fed rate cuts, pricing in less cuts, then it's possible for us to see the global stock market kind of like trading within a range and have some correction to the upside. And on the other hand, there is another risk, which is that the market is kind of like self-reinforcing. Now we're seeing this kind of recession concerns when the companies getting more and more concerned about the economic outlook, then they start to increase layoffs. Then when the consumer feels like the labor market outlook is getting more and more concerning, then they will spend less. And in that case, it will accelerate the economic slowdown. So we think there are two risks ahead that need us to focus mainly on.
We're seeing this big fall in iron ore back to $90 a tonne, and oil obviously had a pretty bad week as well. We've seen some of that sort of safe haven demand out of gold as well. How much of this is to do with the severity of the slowdown in China? Do you expect further downside for commodities?
Right. For the commodities, of course, for those related to China's construction industry, then that kind of commodities are likely to remain under pressure at this juncture because for those Chinese data, it still shows the sluggishness of China's economy, and we're not going to see a reversal of this trend anytime soon unless we have very sizable fiscal and monetary policy easing in China. And that could be the case going forward if we start to see global central banks entering into a rate cut cycle. It will give more room for the PBOC to further ease the policy. And that may be a timing when we're going to see a rebound in the commodity market. And on the other side of the commodity market, which is about the gold market, we think even if the PBOC stopped buying gold for the fourth consecutive month, it does not mean that gold will have a lot of downside from here because there are still a lot of central banks in the emerging market that are still buying gold aggressively. And on the other hand, we also have a lot of retail demand to hedge against the geopolitical risk and inflation risk. And apart from that, we're also going to see a lower U.S. dollar as well as lower U.S. real yield, actually supporting a return of the ETF gold inflows.
Carie Lee, Global Market Strategist at DBS Bank Hong Kong. Thank you so much for joining us on a day where we continue to see that red around markets. The Nikkei now falling at an average of around 3%. We're talking about 2.9% declines at the moment. 35,332 is your level. And I gotta say, when I was coming into the office today, I was bracing myself for the market reaction, given that we got those U.S. payrolls numbers on Friday, recently missing to the downside. And with that, we got a jump in the Japanese yen of about 1% last week on Friday. So right now, the yen holding at that 142.50 level, which is a little bit of weakening against the U.S. dollar. But of course, that narrative continues about Fed rate cuts coming at a time when we could potentially see more rate hikes from the BOJ, the former BOJ governor Haruhiko Kuroda, signaling the bank actually has a lot more room to raise costs in its policy normalization process. So we're seeing the Nikkei now down about 3%, the Topix also down about 2.7%, and really not as severe a market reaction as we saw after the July payrolls numbers, but right now we're still seeing a sea of red across Asia. And there are a couple of stocks that we're following at the moment. Take a look at Seven & I, because Couche-Tard told Seven & I that it wants to work together to agree a, quote, friendly takeover, that they're actually disappointed with the reaction and rejection that we got initially from Seven & I when it comes to Couche-Tard's offer. We're also following Mitsubishi Chemical. The Nikkei has reported that they're seeking to sell Mitsubishi Tanabe Pharma unit. They apparently hired a financial advisor, and they're sounding out possible buyers, including foreign investment funds. This is according to local media reports. Heidi.
Take a look, Shery, at the iron ore miners. Of course, they're front and centre as we see that price slipping to $90 a tonne, the weakest since November 2022. And we are seeing, unsurprisingly, quite a bit of downside. Interestingly, that sort of, more or less still pure play iron ore name of Fortescue down by about 0.9%. We're also seeing some steep declines there for Rio Tinto. I should point out most of these iron ore producers actually were pretty resilient and robust in terms of their latest numbers, but there is some concern with Bloomberg Intelligence saying that that weak China demand story continuing to play out. The mill profitability that we continue to see sustained weakness for could continue to weigh on iron ore pricing from that 2024 to 2025 demand sort of framework as well. The government support measures that we've seen have so far really failed to restore much confidence, and we're still seeing slowing infrastructure build-outs as well as just a slower sentiment despite the sort of manufacturing investment that continues in China. So that is a picture of weakness, although I should say BHP is actually just sort of flip-flopping and now in the red by about 0.1%. We continue to watch for these economic indicators out of China. The inflation numbers will be out a little bit later on, and of course we are expecting a flatline reading for consumer price inflation and deflation on the factory gate side continuing to worsen. So watching to see for some of these China proxies, and of course a lot of that is either the Aussie dollar or some of the Aussie miner-related ones as well. More ahead on the Asia trade. This is Bloomberg.
On September 10th, as Election Day approaches, Vice President Harris and former President Trump hit the stage for the first time.
Oh, we're going to beat her. I look forward to the debate.
If you got something to say it to my face.
We'll bring you informative analysis.
Will that debate decide the outcome of this election?
It's going to come down to both policy and performance.
Tune in to Bloomberg Television for the ABC News presidential debate simulcast with special coverage starting at 8 p.m. Eastern. Context changes everything.
We continue to watch Mitsubishi Chemical at this point because they're now reacting to a report by the Nikkei that they're in the early stages of negotiations for the sale of Mitsubishi Tanabe Pharma. They're now saying that this was not announced by the company and there's no such fact, but that they are continuously reviewing their ideal business portfolio for the entire group, including the pharma business. You can see the stock a little bit under pressure at the moment. But in the broader Japanese economy, while second quarter GDP expanded at a pace slightly slower than the government's initial estimate, it may still be enough, though, to keep the BOJ on track to raise interest rates again this year. Our Japan economy and government editor Paul Jackson joins us now for more on this. And Paul, I mean, this data is backwards looking, right? But it was a slight downgrade. What should we make of it?
I think the overall picture is largely unchanged. I mean, it's a rebound story. We did have a very poor beginning of the year. So 2.9% quarter on quarter sounds pretty good, right? I'd say it's a slightly flattering figure because if you think of that start of the year was very poor. So, of course, in the second quarter, there should have been a good rebound. Now, looking at these revisions, we've seen consumption knocked down a little bit. CapEx figure also revised down a little bit. But I think the broader picture is both of these figures are up in the second quarter. That shows that, there is a little bit more energy coming into the economy, especially on the consumption front. That was 4 quarters of drops up until then. So I think these are largely positive figures, both for the government and for the Bank of Japan. The figures coming perhaps a little bit too late for Prime Minister Kishida, but still keeping BOJ largely in a good spot, I think.
And it's really interesting for the BOJ because remember after the U.S. payrolls numbers from July, we got that huge meltdown in the markets and everybody was like, well, the BOJ hiked too fast or they were too hawkish. And it seems the data after that has been actually supporting their move.
Well, in terms of the data this quarter, I think we're seeing a bit more of a mixed picture. Retail sales was up about 2.6% year on year. I mean, that's lower than the overall inflation rate at the moment. So it's not exactly a strong figure. Household spending just about eked out growth. I think what we have seen that's positive is the wage data. That's certainly been good. And, of course, that's one of the key metrics for the BOJ as it tries to weigh when it's going to make its next rate hike.
We heard from a former BOJ official saying that the rate of moves from the BOJ could actually be a lot faster, and he actually sees potentially 2 more moves this year are possible. There's debate as to whether that is likely, but I suppose how much of a challenge does this create when it comes to the communication side? Because his other advice is that the BOJ needs to not catch these markets unaware.
Well, in terms of communication for central banks, I mean, can you ever get it perfectly right? It's a very difficult job. If you put everything on the line ahead of time, markets can move on that, and then things can turn in the wrong way. So this is very challenging to get the communication right at any central bank. I think Ueda's been very clear that if projections continue as expected, is going to keep raising rates. So, in a sense, all the hullabaloo around the July rate hike, a little bit overplayed. I mean, he said he was going to be raising rates, and certainly in the days beforehand, we're all pretty sure he was going to. But it does show that markets can get jittery, things can set them off when they're in a kind of fragile state, and I think that's the situation that we're in. And this is what these kind of like trigger points tell us. It's about market fragility still there as people try and gauge what's going to happen with the Fed, what's going to happen with the BOJ over the coming months. And I think, obviously we are going to see rate cuts at the Fed, and we are going to see another hike from the BOJ.
Our Japan and Korea economy and government editor Paul Jackson there. Speaking of fragility and market expectations, take a look at China. Beijing said that they'll fully open its manufacturing sector to foreign investment and is also allowing more room for overseas capital in its health sector. Our China correspondent Min Lo joins us now in Hong Kong. So these sort of, market opening overtures coming at a time where there's not a great deal of confidence in the Chinese economy.
Yeah, it comes less than 2 months after the conclusion of the third plenum. So this is the government really following up on some of those pledges that Chinese officials, the top leadership has made about opening up the sector. And it's clearly a bid to get more foreign investments back into the country after we saw huge outflows, close to 30% declines in the first 7 months of this year. Some of the changes include opening up the entire manufacturing sector to foreign investment. Bear in mind that there were already zero restrictions when it comes to investing in manufacturing in the free trade zone. So they were lifting the rest of the restrictions that applied to the rest of the economy. And I think what's most significant is the Commerce Ministry's announcement that they are opening up the healthcare sector to allow full foreign ownership of hospitals in big cities like Beijing, Shanghai, Guangzhou, Shenzhen, among others. And they're also opening up the biotech sector so foreign investors can now put money into the development of applications related related to stem cells, gene therapy, for instance. And again, Chinese state media is kind of using this to juxtapose against some of those protectionist measures from the U.S. to signal that China is opening up its doors wider and wider to foreign businesses.
And yet, when it comes to today's price data out of China, we are expecting to see that economic slack being reflected?
Yes, so consumer price inflation, that's expected to improve to 0.7%. So we are edging slightly closer to 1%. Some economists are expecting maybe we can hit 1% by the end of the year. But the most worrying one is the producers' price index. That's expected to deflate down 1.5% in August compared to a 0.8% decline in the previous month. And this is likely driven by the broad declines across the commodities like iron ore, oil and steel, reflecting again that weak domestic demand in the country and again perpetuating that vicious cycle of companies trying to deleverage and pull back investment and hiring and consumers holding back on spending as well. And so you have the PBOC's former governor Yi Gang saying that inflation is that target that China really need to pay attention to, and the hope is to turn the producers' price index around to positive territories by the end of this year. But so far that's not looking very possible at this point, given that we're looking at a 22nd straight month of decline.
Bush China correspondent Ming Lo there with the latest on the Chinese economy and what to expect. We do have more ahead on the Asia trade. This is Bloomberg.
Apple set to unveil its latest range of iPhones later on Monday, including built-in AI features for the first time. Just hours later, the Chinese tech giant Huawei will also launch a new device, possibly with a foldable design. Let's bring our tech reporter Annabelle Jewellers. But what are we expecting from Apple this time around? Are you sort of managing your expectations here?
Yeah, we're really not expecting any sort of major fireworks to come out later today, but we are getting the latest iteration of the iPhone. So the iPhone 16, it's going to have the base model, the Plus, the Pro Max. So 4 different devices coming to the market just later Monday. Yes, there had been sort of expectations perhaps a couple of months ago that we might see a new upgrade super cycle being kicked off, given the anticipation around artificial intelligence. But expectations, as you say, yes, they've been very much managed through the process, because when you boil it down, based on what we've been reporting, really not expecting any sort of major changes from the iPhone 15 to the iPhone 16 instead. So yes, we might get some new colours in the lineup, but the devices are pretty much going to look the same, save for perhaps a slightly bigger screen model. There's going to be a new action button feature, for instance. That was something for the higher-end smartphones last time around. That could now become standardised, rather. I don't want to get into too many details there, but it did replace the mute switch. We could see a new button to enhance taking photos, but really just incremental changes coming through. Software-wise, that's really where a lot of the excitement is, because we had Apple unveiling its Apple Intelligence features early this year. But again, we've been road testing this at Bloomberg. Our reporter Mark Gurman, and what he's finding so far is basically we're not going to see the full capabilities rolled out just yet. And again, that stops the consumer really reaching into their wallet and thinking about upgrading this time around.
Huawei also unveiling new products.
Yes, that's right. So Huawei, this is really hot on the heels of Apple, and it's going to come just a couple of hours later. Of course, we have seen Apple really losing ground to Huawei, in particular in mainland China. In fact, in the June quarter, they edged out Apple to become the top 5. We are going to get this new device coming through, as we said, just hot on the heels, and so it tells us that they're really preparing to go head-to-head. The focus could be on foldable design this time around, so we're kind of used to seeing a twice-folded phone. This one could be foldable 3 times, or a tri-fold screen, so it lets you have more screen space in a smaller smartphone-sized device. What else we could be watching very much as we get any sort of announcements around semiconductors. Of course, Huawei has been quite challenged in putting out more versions of its Mate series. We're expecting the Mate 70 perhaps later this year. But again, we could see an announcement around semiconductors and how Huawei is managing to evade those US sanctions and impact to its advanced chip-making capabilities.
Annabelle Jewelers there joining us from Hong Kong as we, of course, continue to watch the semiconductor space. You can read more about Apple and its rise to become the world's most valuable company on today's Big Take. This is Bloomberg.
When you think about what will drive it, the pace of consumer spending, that's important, and that remains quite solid. We're not seeing layoffs. We're seeing less frenzy in terms of hiring and job openings, but we're not seeing meaningful layoffs. Unemployment insurance claims remain at very low levels. So I'm attentive to downside risk now on the employment side, but what I think we're seeing and hope we will continue to see is a good, solid economy.
U.S. Treasury Secretary Janet Yellen on the U.S. job market. And of course, after the payrolls data that we got on Friday, we continue to see the downside across Asian markets. We had seen the Japanese yen really strengthen against the U.S. dollar. We continue to see that around that 142.70 level, perhaps a little bit of weakness. But when it comes to the broader markets, we're talking about declines for the Nikkei of more than 3% at one point early in the session. We're seeing that semiconductors are the biggest losers today. Intraday, you're seeing the likes of Renesas Electronics, Advantage, LaserTech as well. Some of the big losers on the MSCI Asia Pacific region, Haidi.
Shery, as the U.S. presidential race enters its final stretch, a new poll has Republican nominee Donald Trump leading his Democratic rival Kamala Harris by just 1 point. The survey by the New York Times and Siena College shows support for Trump at 48% against 47% for Harris, within that 3 percentage point margin of error. Harris and Trump are set to face off on Tuesday night in Philadelphia in what's currently their only scheduled debate before the November vote. The annual CITIC CLSA Investors Forum begins in Hong Kong today, bringing together senior executives and investors to discuss top issues from geopolitics to the macro environment. Our next guest is one of the speakers at the forum, and joining us now is Republican pollster Frank Luntz, who's the CEO at FIL. Frank, really great to have you with us. And, you know, we talk about there's really not much between the two candidates if you take a look at the polling over the past few weeks, right? The question for Kamala following the DNC was always whether she was going to be able to maintain that momentum. Is that what you're seeing?
That's exactly what I'm seeing. And in fact, I waited to the CLSA Investor Forum to discuss some of the latest focus groups that we've done and the polling that we've done. And what we find is it only matters in 7 states. So let me give you a preview of what I'm going to be saying. Those 7 states, Pennsylvania, Michigan, Wisconsin, Georgia, North Carolina, and western states, Nevada and Arizona. That's all that matters. And there's 5% who are undecided right now. And basically, they don't like either candidate. They reject Trump because of his attitude and his persona. And they reject Harris because they don't know enough about her. They want to know more of the details. And they're waiting for this debate tomorrow night. Trump on one side, Harris on the other. They want to see the comparison, and that's when they're going to make their decision. Tomorrow night will be the most important day of the entire campaign. And I, like tens of millions of Americans, are be tuning in to see whether Donald Trump can keep quiet and whether Kamala Harris has the details that the public wants.
Out of those handful of critical states, how do you rate Pennsylvania? Because we've seen both parties really doing very specific, strategic outreach in Pennsylvania. Is it going to come down to this state? And do you think these strategies are working?
If I'm asked one state to focus on, it is Pennsylvania. And in fact, I'm going to be spending a lot of time there over the next 60 days because it matters that much. And the key vote are people who live paycheck to paycheck. I know that on this show, you focus on jobs, you focus on interest rates, you focus on the economy. There's one issue that Pennsylvania cares about more than any other, and it's not inflation, it's affordability. Food and fuel, housing and health care. Which candidate is going to bring down prices to give the public the ability to afford the house they want, the health care they deserve, and the food and fuel that they absolutely positively need? Pennsylvania is ground zero for this election.
Frank, the very first time that we ever spoke was actually in Hong Kong, and that was leading up to the 2016 presidential elections. And I remember you were telling me about how ingenious these red MAGA caps were, how really Trump was bringing this new energy to the Republican Party. Tell us a little bit about how much he's changed the Republican Party at a time when we're also seeing lifelong Republicans breaking with Donald Trump himself.
Well, the entire political ground has shifted. It's an earthquake. That you have people who are voting Republican now that have never, ever considered doing so. Young African-American men that used to be 90% Democrat. Trump is now getting 30% of them. Workers in unions, not the government unions, not the education unions, but other unions are considering voting Republican for Trump for the first time ever. Similarly, the Democrats, when Harris became the nominee, young women were so excited and so enthralled and so passionate because they did not have a candidate to vote for, and now they do. So you've got this shifting that's going on both sides, which is why this election is so darn close. And you can't call it right now because it's one thing to support a candidate. It's another to actually take the time to go out and vote. There was a time when Trump had a 10-point advantage over Joe Biden on definite voting, on the actual participation. Now, arguably, Harris has the advantage over Trump in turning out her vote. But we will see in 60 days.
Frank, looking at the election campaign unfolding in the U.S. and the big focus on the Harris campaign on joy and bringing back this joy when it comes to politics, it sort of makes me reminisce about perhaps Barack Obama's message of hope. Can she capture sort of the middle of the road voters that are really undecided between two parties if she gets some of those more sensible policies that could also resonate with moderate Republicans?
So that's the key question, and I would reframe it a little bit because I don't think joy excites people, excites your base. It excites those who already support you. And Trump is saying that we need to make these changes, that the last 3.5 years have actually made things worse, not better. In the end, the key question that will decide this election is quite simple. Are you better off today than you were 4 years ago? That is the question that Donald Trump needs to ask at the beginning of the debate and at the end of the debate. And for Harris, do you want the same chaos that we've had 4 years ago? Do you want to bring it back today? Because voters have had enough of that. They're genuinely challenged. They're challenged when they wake up in the morning, when they go to sleep at night, paycheck to paycheck. 23% of America, higher in Pennsylvania than any other state. Can the candidates win the paycheck to paycheck voters? Those are the ones who matter. There are millions of them in Pennsylvania and many more millions across the country. It's the candidate not that has joy or not that's seeking to revenge. It's the candidate that can address that concern. Can I make it through the day? Can I make it through the week, the month, the year? That's the candidate that wins in November.
So this doesn't hinge, the result doesn't hinge as much on enthusiasm and therefore turnout as much as actual, specific policy detail.
Yes, it does. The turnout is important. But for Harris, her challenge is that the public still doesn't feel like they've got enough detail. They want a detailed plan of action from her. And for Trump, he has to show that he can keep his anger in check because they support Trump's policies on inflation and immigration more than Harris. But they like Harris and they like her persona and her approach more than they like Trump. If the election is about issues, Trump wins. But the problem is he makes it about persona, so he's his own worst enemy. For Harris, she has to prove that she's got the details that gets the public to trust her, but she's not told us enough of where she stands, so that's her weakness, which is why tomorrow night's debate is so important.
Frank Luntz, good to have you back, founder and CEO at FIL, joining us actually on this side of the world in Hong Kong. As we continue to watch the uncertainty around U.S. elections, the uncertainty about the economy, we do get U.S. CPI numbers later in the week. We're also watching what's happening in China. Of course, we had price data, not to mention activity data as well. Weakness in Chinese equities, eroding the confidence of some of its biggest supporters on Wall Street as hopes of a turnaround fade. Asia equities reporter Winnie Su joins us now for more on this. And Winnie, why are we seeing all of these downgrades all at once? This has been happening for a while already, the weakness of that economy.
Right, that's absolutely right. But it just seems like even the most bullish investors are now seeing a lot of signs of how the weak economy and the weak market is likely to stay. And like you mentioned, we've got on the macro side of things, people are less convinced now that China might be able to hit its 5% annual growth target. And with the government stimulus not really helping with the property crisis and the weak domestic demand. And on top of that, we just talked about Trump's poll results. So the ongoing U.S.-China tension and the upcoming U.S. election is likely to add to more volatility in the market. And with the trade wars, that's also going to hurt Chinese stocks for the longer term. And on the market side of things, we're actually seeing CSI 300 headed for its fourth year of losses, and earnings outlook for China is actually looking one of the worst in the global market. So all of this is really showing that this market seems to not be showing much of a sign of recovery.
But given what you've said about the impact on the markets already with the CSI 300 falling so much, you would think it's cheap? Are valuations at least going to help, or are we going to continue to see that bearishness?
Right. So to some extent, we can see more bearishness in the market. Just now, I talked to SocGen. They were saying that they're going to publish the outlook next week, and they're likely to revisit the thesis around the Chinese market. And when I talked to UBS, they mentioned how the pessimism around China stocks was actually more than what they expected. However, some of the tactical short-term positive things are still there. Like you mentioned, there's the low valuation, and because the expectation is so low, with just some level of stimulus, we can actually see a good rebound in the market. And the Fed rate cut is going to lead to some weakness in the dollar. So the strength in the yuan is actually going to be helpful for some money to come back to the Chinese market.
Where are we seeing investors put their money instead? Is it still sort of flows being directed into markets like India?
So India is by far one of the most attractive markets that we're hearing investors rotating their money into, citing the strong economic growth and also the progressive reforms. However, other EM markets, for example, there's smaller Asian markets like Malaysia, like Indonesia. Those are likely to benefit as well, especially if we're seeing the Fed to cut rates and local Asian currencies to strengthen. That's going to help those Asian markets as well.
Our Asia equities reporter Winnie Su here with the latest on what we can expect from the market moves as we continue to watch, of course, the downside in the Japanese market, especially when it comes to those semiconductor names. Some of the biggest losers in today's trading session are those chip stocks, with Tokyo Electron falling more than 6%, Renaissance also losing more than 7%. When it comes to the MSCI Asia Pacific region, we are seeing those broader chip stocks also leading the declines. Not surprising, perhaps, given that we had the Nasdaq 100 losing the most since November of 2022 last week, led by Nvidia's 14% plunge. We'll continue to watch this sector, Heidi.
Watching European equities futures as they come online as well. Certainly not a great lead that we see. And in fact, just the risk of heightened volatility that was being delivered by, the kind of limbo status of what the Fed does next, right? That labour market report really failing to provide much clarity on the size and scope of the rate cut this month and what's more to come. We are seeing Euro Stoxx 50 futures looking a little bit more optimistic there. DAX futures up by about 0.1% there. We did see weakness, though, for 5 straight sessions going into the end of the week, and in particular a lot of the weakness coming from rate sensitive sectors, real estate, utilities outperforming, tech falling out of favour. They're trading at their lowest in Europe since about January. We're also going to watch for that continued impact of the weakness in China, given a lot of strategists saying that the sell-off across luxury stocks, that has only just begun. More ahead on the Asia trade. This is Bloomberg.
Malaysian convenience store chain 99 Speed Mart is set to make its trading debut in Kuala Lumpur later today. Equity Capital Markets reporter Felipe Pacheco joins us now for a preview. And Felipe, this is supposed to be one of the largest IPOs in Malaysia in years, so expectations must be super high at this point.
That's correct, Shery. Good morning. And this is a very meaningful deal for the Malaysian market. We haven't seen a deal this size in about 7 years, Shery. You're talking about $500 million that were raised by this IPO. And this is a very interesting case because it tells a lot about the moment in the market and also the consumption sector. This is an equivalent, let's say, to a competitor of 7-Eleven. It's a convenience store chain. You can find it across the country in Malaysia. It's an extremely popular name. It has about 40% of the market share for all of the mini-marts across the country. And of course, this is a way for investors to build exposure to this segment that's expected to be one of the strongest within Malaysia's economy this year. The country is expected to, GDP is expected to increase around 5% in 2024. And it's one of the best prospects that you have within Southeast Asia. This is definitely being reflected in the IPO market because KL right now is the busiest spot for IPOs in Southeast Asia, Shery.
This story behind the company's founder reads like a screenplay in terms of how he just became a billionaire from, you know, the origin story of really severe physical economic limitations.
Haidi, that's correct. It's apart from the fact that the business itself, it's quite meaningful to Malaysia and to the moment that the market is in. The story behind the founder of the company is very impressive and it's extremely inspiring. He is the son of 11 kids. His father was a construction worker. His mother was a hawker. He started selling goods at a very early age in a roadside in the coastal city of Klang in Malaysia. From that moment on, he started his first shop in 1987, about 37 years ago, and now he has an empire that it's built around 2,600 shops across the country. It's very impressive to see how he built this empire from pretty much scratch and how he's perceived as a very meaningful name, a very inspiring name for the market as a whole within the country. He was the main seller of shares within the IPO. His net worth is around $3.3 billion today, and of course, that number can increase if we see the shares trading higher as soon as they start trading in Kuala Lumpur today.
But Felipe, did they have to time the trading debut right after U.S. payrolls? I mean, what are we expecting in terms of performance today?
Shery, that's a very, very good point. It will be very interesting to see how trading happens in a few minutes in KL. Because there is when you look at analyst reports and those that were actually tracking this IPO, they say that the segment, the industry is very interesting. Investors are seeking to build exposure to consumption in the Malaysian market. The story is very good on itself. It's a very strong name within its segment. And most of those that are actually following the company are expecting an increase as soon as the stock starts trading. There was demand for about 14 anchor investors within the IPO. They were buyers. They're not expected to sell as soon as the stock starts trading. And we're talking about some very big names such as Aberdeen and UOB Asset Management. So it's a tough day. It's a very interesting market. It's a very interesting moment. So let's see what the stock is going to do in a few minutes from now, Shery.
Equity Capital Markets reporter Felipe Pacheco there. Let's get you caught up with some of the other headlines we're following across the corporate front. And Boeing and its largest union say they've reached a deal to potentially avoid a strike at the troubled US aircraft maker. The offer includes a 25% wage increase over 4 years and a commitment to build Boeing's next plane in Seattle. The breakthrough came after a marathon bargaining session, but it's too soon to know if workers will go along with the deal. Westpac Banking has named Anthony Miller as its next CEO, succeeding Peter King, who's retiring after 30 years at the lender. Miller is currently head of the Business and Wealth Division and will take the top job from December 16th. The incoming CEO has been with Westpac since 2020, previously holding senior roles at Deutsche Bank and Goldman Sachs. Shery.
Heidi, take a look at how Samsung Electronics is trading at the moment. It's another down day. We're talking about 4 sessions of losses already. And today we're seeing especially the pressure given that Samsung Electronics has been now downgraded by KB Securities and CLSA. Their price targets have been lowered. They're citing softer demand for new tech products. So the stock is now trading at the lowest level since October of 2023, down for 5 consecutive sessions, the longest losing streak since May of this year. KB Securities reducing the price target to 95,000 won from 130,000 won. We have more ahead on the Asia trade. This is Bloomberg.
Well, as Nippon Steel's proposed takeover of US steel founders, Bloomberg opinion columnist David Fickling says politicians should not cling to a vanished history to save blue-collar workers. David's here for more. And you argue about, the lessons learned when it comes to some of the difficulties in being able to shut down fossil fuel power in other markets.
Yeah, I mean, one of the big outcomes of the 2021 Glasgow Climate Conference was these things called the JETP plans, which were going to places like Indonesia, South Africa, Vietnam, Senegal, and really trying to break some of the nexus between like fossil fuels and political power in those countries. The idea being that if you do that, then the economics will do the rest. In all of those countries, I think we've seen it's been a lot more difficult than the framers of these plans anticipated. And I think if you look at what's happening with US Steel and Nippon Steel in this deal, you can kind of see why.
These are independent steel producers, though, as opposed to the state-owned structure. Does that make a difference?
I mean, in theory, it does. I think in practice, if you look at the history of steel industries, they're treated as national assets. Look at the angst in the UK over the sort of decline of the UK steel industry there. Look at US Steel itself. It's America's first billion-dollar company, founded by Andrew Carnegie and John Pierpont Morgan. This is the company that built America's railroads, its skyscrapers, its war machine. Similarly, Nippon Steel is its steel mills were at the heart of Japan's industrialization. And on top of that, there's a similarity in how these businesses work. Traditional power generation operated on this baseload idea. It was always switched on, and it's really struggled. These industries that are always switched on have struggled as things like wind and solar have come in, which switch on and off, and it's a big problem for those industries. Similarly, with steel, these old-style blast furnaces, powered by coal, they have to be on for 20 years at a time. What has happened in recent years is electric furnaces, like the ones operated by Nucor, which is US Steel's big rival, they've come on board and they've really challenged that business model.
Just super quickly, unions saying that they have to reject this deal to preserve jobs. What do you think?
Well, I mean, I think if you look at what's happened, US Steel has lost about 40% of its jobs over the last decade. Nucor, using this new technology, has gained about 36% of jobs. And Pittsburgh as a whole, Pennsylvania, the heart of US Steel's business, it's lost 40,000 manufacturing jobs since 1990, but it's gained 200,000 services jobs. So I think actually the best outlook for jobs is not to try and fight the future.
Our opinion columnist David Fickling there. That is it for the Asia trade. Our markets coverage continues. We look ahead to the start of trading in Hong Kong, Shanghai and Shenzhen with the China show next. This is Bloomberg.